benefited you relative to your benchmark, and also the changes that you've made out. So we hope that momentum will continue as we go forward. Are there any questions about the broad overall fund? So now we can go to the detailed equity classes and equity.
Yeah, if maybe I can get you to just
step back. Lord, if we have any history to tell us this one gets better, complete returns, we've had in history of the
It is, I believe. It goes back, I believe it's 1983. This is the best return since 1983 that we've had.
you know, ranking like 10% out, that's something else.
It's very good, and we're going to enjoy it while we can. Our equity exposure is either going to serve us well, or it's going to sink us. So, so it will. It's fortunately for us, it's very early in the fiscal year, so we've got some time. And I stand corrected. It's the best return since 1985. In 1985, we had 26.2% return.
Well, also, I neglected to say too, is that when I was talking about the strategic asset allocation, is that when we had all this volatility, we had been in communication with Lori and our other clients about just that this is something that is sort of a fact of life. We've seen volatility before, and you have that strategic target. And what we always suggest is, stay the course, stick to the strategic target, and don't do anything rash. And we think that will pay off.
How does the 25-4 compare to other systems in the country? 10 percentile.
10 percentile.
Yeah, you can the range of returns.
Yeah, well, the range of returns would be anywhere from 18, let's say 18% to 25%. You're right there. I mean, you're essentially. There's some others that have your returns. You can see though it's been a good for a lot of public funds, a good return fiscal year, which is going to be beneficial given the issues that a lot of public plans have. But it was right up there.
The median public fund is up 21.7%.
So that means half or
well ahead of that median.
How many public funds do you have in this?
I've got it on my desk because they asked. I want to say in the group,
there are 111 public funds with an aggregate asset under management of $1.32 trillion. 111. And the big ones, I
think it's 84 or 85.
85 in this particular group of billion. Yeah, all assets.
that includes all the big ones.
Yeah,
California,
New York, yeah, Ohio, yeah, California State.
I think as we talked about before, we supplement our client data with other providers just so it's not all Cal clients, so you get good representation.
Yeah, the top 5 of the California PERS with $213 billion, California State Teachers $166 billion, Florida State Board $120 billion, Pennsylvania Treasury Department $89 billion, New York State Teachers $69 billion. So you can answer 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 14th largest on the Fed.
And I've seen all their returns, and we did better.
Yeah, you did better than.
Say that again, 14th largest fund in the country?
Okay. Well, it would be, well, in our database, which would,
It's
yeah.
in
There's
Cal's
other, yeah, I
database.
mean, if you throw in the federal retirement system, so that.
We used to be about 60.
We're 65th of the top 1,000 pension plans.
And that's
in America.
corporate and as well as public. It's not, that's not just the public.
So it's very respectable reading, but again, like we'll see it, we'll hope that momentum continues.
And I'll, if you want to turn back to pages 27 and 28, I'll touch on some of what I think are some of the highlights from the quarter on the equity side for both domestic and international. As Bill alluded to this morning, it was, if you look at the indices, generally flat to slightly down quarter, but a lot of variability in between that. If you looked at what did well, larger cap stocks in general did better than smaller, growth did better than value. Again, too, that's a dynamic that's different than what we've seen in a lot of the past quarters. On the international side, basically, if you looked at non-US markets in local currency terms, they were very similar, flat to slightly up, slightly down, but the dollar continued to weaken during the quarter, so that helps the US dollar investors. So when you actually look at the returns for your international managers, they're in general better than what we saw from domestic, but largely driven by currency. The big overhangs that were out there during the quarter, the debt ceiling debate, a lot of uncertainty in the market, continued trouble with some of the peripheral European countries, Greece, Spain, Portugal, the pigs as they're called, still cast some issues over the European markets, but also U.S. markets. So if you look at page 27 on the domestic side, your overall domestic equity return for the quarter really echoes that, 0.17%. Slightly better than zero, but again, if you look at that overall, this is taking into account your large, mid, and small cap allocations. You were in the top third of the peer group. While it's not a lofty return, relative to peers overall, that equity allocation did well. And you take that out over the last year, just under 35% return. And in fact, as we just talked about, looking at any of these one-year returns, it might be a while before we see 30 and 40% returns over a one-year period. So across the board, in absolute terms, those are pretty impressive numbers. And that holds true for your domestic equity too, almost top quartile for the last year. So as a whole, that allocation is working very well over the short term. One of the standouts is, as Ken mentioned, Eagle, your all-cap manager. In a generally flat market, almost 2 3/4% return for the quarter, the second percentile. So they beat 98% of their peers. And again, looking out over those longer periods, top peer group rankings for them across the board. And really their stock selection has been a big driver of that performance. On the large cap side, both of your active large cap managers, Paez and Intech, both turned in strong quarters. Intech's a manager that, probably predating us being here, I know because we have them in other places, had struggled. It's a quantitative manager. They went through a couple of years of really being out of favor, but you look at the performance now, again, for the quarter top decile, and looking back over the last year, getting up into the top third or even the top quartile, depending on what period you want to look at. So sometimes it's hard to stick with the manager through the bad periods, but this is a manager that's definitely turned around and started performing an issue of hope. On the mid-cap side, as Ken mentioned again, Artisan, the standout in this group with a 2.8% return versus negative performance for the other managers. While energy was an area that didn't do well during the quarter, they actually picked some pretty good energy stocks that did perform well, and that was one of the main contributors to their performance. On the small cap side, again, negative across the board on both the indices and the manager performances. As you have, in general, investors fleeing to safer areas, a lot of money flowed out of small caps. DFA, Dimensional Fund Advisors, this was actually one of the worst performers, not only in small cap, but in the fund for the quarter. And if you remember what DFA does, they tend to have a very large portfolio with a lot of smaller capitalization stocks. And as you went down from large to mid to small to even micro, the smaller you get in forgotten market capitalization, the worse the stocks in general did. And if you look at DFA's portfolio, it tends to be smaller, so that hurt them for the quarter. But overall, if you look at your small cap allocation, a little bit behind the index for the quarter, but not dramatic. On the international side, Acadian, manager that's been on your, or is currently on your watch list, actually turned in a very strong quarter. Again, top decile performance for the quarter, which looking out over the year puts them in the top quartile. And again, going out 3 years, you can see some of the troubles they've had. Again, a quantitative manager, and it's been a tough period for quant managers of any style, be it domestic or international, to perform well, but certainly a nice rebound for Acadian during the quarter. On the, take it down to the EFA composite, that's the Europe, Australasia, Far East, the developed international markets. Basically in line with your index for the quarter overall. A couple managers drug that number down a little bit. Again, dimensional fund advisors, a similar story to what I said on the domestic side. It tends to focus on some of the smaller cap names, which detracted internationally as well. Juroslavsky Fraser, I believe, was in absolute terms, the best performing manager within your fund. Top second percentile, so beating 98% of similar managers at 5%, so that was a big boost to your performance and helped offset both New Star and dimensional fund advisors, which were lagging a bit during the quarter. New Star was hurt by some of their tech stocks and some of their energy stocks as well. Those were two areas that didn't perform particularly well during the second quarter. On the regional side, where you have your Pacific Basin exposure with Cap Guardian and your European exposure, both managers perform fairly similarly to the index, not big divergence there. Actually, the Pacific Basin slightly outperformed the Europe, slightly, I guess, matched or underperformed if you look at the value, or overperformed. On the emerging side, when you have capital fleeing risky assets, emerging markets can be a tough space to be in. Although overall, you have a marginally negative return for your overall allocation to emerging, that was still in the top half of the peer group. So that implies it was a tough space to be in during the quarter. Again, largely driven by uncertainty and folks fleeing the riskier areas and moving to the safer areas. So overall, top half emerging markets performance. And if you look at that whole, again, that whole overall equity allocation, what your return was, just under 0.5% for the quarter, which, considering largely negative or flat performance, not a bad return, over 33% for all your equities over the last year. You can certainly delve into any of these managers if you have questions. Otherwise, maybe we can move on to fixed.
Okay, if you will, turn with me later in the book to page 106. And I just want to tee up the fixed income managers. You're going to hear from your active managers later today. Page 106 puts all of your domestic fixed income managers into one portfolio. So here's your composite. And we can compare it versus other domestic fixed income portfolios of other public funds. And so we saw for the total fund, you outperformed your benchmark by over 300 basis points. A lot of that came from fixed income, where you put it all together. Now you've got some passive managers in here as well, in addition to the active. We put everything together for the last year, you're up 200 basis points over the BC aggregate. So, and right around median. Look at the bottom left-hand chart where this fixed income portfolio has beaten the aggregate now for 2.5 years. Going back 2.5 years, every quarter. So certainly 2008 was an extremely challenging year for active managers. They have rebounded nicely, and so now the long-term results are a little bit ahead of the index, right around median when we put them all together. So let's quickly take a look at the first active manager is Aberdeen, and that's page 109. Aberdeen is a UK-based manager, although this fixed income team, they're based in Philadelphia. They really have a bottom-up approach, focus on security selection. They're not gonna take big duration bets, nor will they take big top-down sector bets as well. Aberdeen had, this is one of the managers that's on watch, but they had a really good fiscal year 2011 for you, up 6.3%, well ahead of the benchmark at 3.9. They were near the top decile in the peer group. And you can see what's happening with Aberdeen in the bottom left-hand chart again on a relative basis each quarter versus the index. So they got in such a hole in 2008, particularly that fourth quarter of 2008. Look at the scale on that. They were down just in that quarter alone almost 15% versus the index. And so that's just destroyed their trailing 3, 5, and 10-year numbers. So it's we are encouraged that they have been outperforming now for about 2.5 years straight, but they still, it's going to take them a long time to get back on those longer-term results.
Also, you just look at that chart in the lower right-hand corner on 109, that's the risk-reward chart, and they're in the high-risk, low-reward quadrant, which is, you don't want to be there, but again, those crosshairs are the median manager, they have median risk and median return. So you can see that 2008 moves through.
Now, next up is PIMCO, page 112, next active manager. So another just core mandate. So all these managers we're talking about right now are just U.S. investment grade only. And PIMCO has more of a top-down approach, and it's been very successful over the long term. For the fiscal year, they're up 5.75%. Again, almost 200 basis points, better than the index, 21st percentile, and they're in the top quartile every time period shown here. So they've been a good, consistent performer, and that's really evident by the bottom right chart, risk adjusted over the last 5 years. So they're well ahead of the crosshair represents the median core bond manager. And so PIMCO has delivered over this 5-year time period well above median returns with just a little more than median risk. So overall, they've been compensated for the level of volatility. So very pleased with that portfolio. And next up is going to be Loomis Sales, page 121. So Loomis is your sole core plus manager. So unlike Aberdeen and PIMCO, Loomis can go and invest in outside the benchmark. They can go up to 20% in high yield securities and up to 10% in non-dollar securities. Now, at the end of June, they had 19% in high yield. So they were near that limit, and they had 1% in emerging market debt. So they'll typically, so their specialty outside the benchmark is more in the high yield space. They're not going to do a whole lot in the non-dollar. But Loomis, it's a relatively newer manager. You've only had him for 1 year and 3 quarters. And for the fiscal year, boy, they had a fantastic year, up 9.2%. And remember earlier I talked about how the spread sectors did well, and so having a big allocation to high yield for the full year really helped this portfolio. And since you've hired them, they've only had 1 quarter where they've underperformed the benchmark, and that was back in the second quarter of 2010. And then lastly, we've got the next tab, page 124. International fixed income. So this is another fairly new add to the program. Wellington Emerging Market Debt. They now have 1 year of history, and it was a very good year, up 14%. When you think about you decided to take money away from the BC aggregate and that kind of traditional domestic fixed income portfolio, you put almost, well, right now they have almost $400 million. And they returned 13.9. The benchmark was up 11.4. So this space, this part of the bond market did very well in the fiscal year. Now it's mainly emerging market sovereign debt denominated in US dollars, but they do have a little bit in local currency, about 7% in local currency debt, and they have 5% in corporates. So they're able to opportunistically buy some local currency debt and some corporates, and those have both done well recently as the dollar declines. So local currency debt is going to appreciate. So that's fixed income. No questions? No.
One question. If you were to take out the currency differences in that, almost 14%, how much of it would be actual return?
Well, it's going to be, most of that's going to be actual return because they only had 7% in non-dollar. So I don't know, do the math, but
Yeah. They actually invest in emerging market debt, but it's dollar denominated, so everything they do is in US dollars. So we don't have a whole lot, unlike our equity portfolios that are almost all local currency. This Wellington account is almost all denominated in US dollars. So that is the actual return from the security, the underlying securities, with the exception of
Good news.
it is good news.
yeah, so overall, pretty good
Yeah,
with
right.
the fixed income portfolio.
But even this one is 6.5% now. We'd like to be on the next side of that.
Yeah, it just, yeah. But look where the index is. You don't want to be down there, right?
No.
91st.
But somebody got it there.
Well, yeah, I had commented on the, the real estate and private equity earlier. I don't know if you want to go into that. Essentially, your funding phase returns have been okay, and you see negative returns in the early years of any of these investments because it's typical. It's called the J curve. You put money in, and hopefully it'll be harvested later at a higher rate. But we see no issues with your space. Keep funding.
And I forgot to mention, with the S&P downgrade, there are two other rating agencies, Fitch and Moody's, and both of those agencies have affirmed the AAA rating. So your guideline with respect to your fixed income managers, that they have a certain level of overall quality, that has not been impacted by S&P going out on their own and downgrading.
Is it appropriate to ask whether Callum has a position on the level of big recession possibilities?
Yeah, sure. Whether the official response is,
50-50.
no, I mean,
On one hand, but on the other.
No, we're in the camp that we're not going to have a double dip, but the growth is extremely slow. And the danger, really, I think, is more of where it becomes a self-fulfilling prophecy. The markets keep going down and people lose confidence, and maybe we do go into a recession. I don't know.
Yeah, I was just going to say, I think it's a confidence factor in what happens in Washington, reactions down together by November when this committee comes and just people feel more comfortable with leadership. That's 50-50.
Well, with all the talk of the U.S. being downgraded by S&P, if you look at what happened to Treasury markets after that happened, the Treasury yields hit all-time lows. So while the U.S. may have some problems when investors look around the world, we still look less bad than most other places. So
That's high praise.
yeah.
Money did pour in, treasuries were downgraded and money poured in, so from all over the world into treasuries. So it is, corporations right now are in probably some of the best shape that they've been in, certainly in the last several years. They've got a lot of cash on their balance sheets. So corporations in this country particularly are on very solid footing. They're not employing people, and employment's going to be the driver in all of this. Corporations are afraid right now to add payroll, and consumer demand is going to drive a lot of, it's a vicious cycle. So But as far as the actual companies that we're invested in, their balance sheets look fantastic. So, you know, as far as investment, time to invest, these are good investments. There's no chance of, there are, the probability of these companies going under is very slim for the most part. Balance sheet's very solid.
Maybe this is a question, but then does the downgrading of U.S. Neck affect the grading of states?
Yes, it will have some effect on ratings of various states, particularly those AAA rated states, which I believe there are only 5 left. I don't anticipate it having much of an effect on the state of Mississippi's rating. But I mean,
Which is what now?
double A minus. But keep in mind, I'm just saying, S&P kept mortgage-backed security AAA all the way to the bottom.
Yeah.
So let's not get overly concerned about what Standard & Poor's believes. And they chose to cut the rating at a point at which politicians in Washington had come to an agreement to raise the debt ceiling, to cut expenses significantly, not as much as I would have liked, but there was a deal made. It seemed to me to be more of a political statement than it was a financial statement. And anytime rating agencies get involved in politics, it's a very bad thing. Before we leave this, I would like everybody to look at page 177, because I think it's important. You know, in the press, in the media, in individual conversations, there's lots and lots of talk about this year's performance or last year's performance, or the last 2 or 3 years' performance. And as fiduciaries, what we have to consider is not what happened today or yesterday or for a short period of time, but the long-term investment performance of the fund. And on 177, it shows that even though we went through the Great Recession in latter part of 08 and 09, our 20-year performance is 8.09% annualized. Our 25-year performance in the fund is 8.39% annualized. Our shorter-term numbers do not look as good as you would expect because of the 2 years of the Great Recession have a much larger role. But if you look at long-term performance and long-term investments, performance is not what has the system in the situation it's currently in, and that needs to be remembered in every discussion that is had about the long-term implications of the another liability.
Mr. Chairman, that is the report for the quarter ending June 30th and the fiscal year 2011. If there aren't any questions, then we will move on with the next agenda item, which is the watch list review. You should have a little bundle called the watch list review. We currently have 6 funds on the watch list.